Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, June 15, 2017. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And what we're looking at here is a garden variety down day. The S&P finished down 5 points. The SPDR finished down just over 0.1% again. No big deal either way. The SPDR was down earlier this morning. The S&P was down early this morning. We had a gap down and we were lower, much lower this morning. We made an attempt at the 20-period moving average, as you can see, but the market recovered nicely and finished at the highs of the day. So that shows you there's strength underlying this market. That's the buoyancy under the market. It's the culmination of the cycle or the ending of the cycle. This is an up cycle, and that's what you're seeing here. And it still has the force, may the force be with you, it still has the force riding the market higher. And so it's very difficult for the major indexes to get any kind of a significant sell going without the buy the dip crowd coming in and the market finding support and rallying once again. So therefore, where does that put us now? Well, on the daily chart, and I want to go through a few different charts because it's interesting, because there is a bigger picture that we do have to begin and continue to piece together, getting prepared for what will most likely be a much more turbulent second half of 2017 than it was the first half, that is. So in just concluding the SPDR, nothing's changed since yesterday. The same upside targets remain. It's options expiration week, so we're seeing a lot of or more wide-ranging days this week than we had the last couple of weeks. So that being said, I'm not going to read too much into the SPDR being down 29 cents. So therefore, there's no change from yesterday. But before we go over to the IWM, and the IWM was down again today and leading the market lower, but we'll get there in a second. What I want to show you is a couple of the other sector exchange-traded products or sector indexes. So look at the XLF. Okay, so the XLF had a nice recovery. It's not, I wouldn't say out of the woods yet, but certainly making a bullish pattern above the moving averages. On the daily chart, there's not a lot wrong with this index. It looks like it wants to go higher. That's a positive sign, bullish for the market. All right. However, we're not at the highs, so we're below the highs. Could potentially make a higher low, however, or a lower high. Pardon me. But right now, bullish chart nonetheless. Moving on, energy sector. Okay, not a pretty looking chart. It's in a very significant downtrend. This downtrend really has a grip on the market. When you go up a time frame and you look at the weekly chart, you say, well, we came into a pretty significant level of support last week, so is this index going to bounce and are we going to rally for a while? This has been a pretty significant downtrend since December, in the middle of December 2016. So we've had 6 months of downtrend. Looks very similar to the dollar. Interesting, right? So I guess the question is this XLE, is the energy sector going to begin a rally now out of coming into support? And this was basically a 50% retrace from low to high. And so it would stand to reason, however, a lot of overhead resistance, moving averages were below all the moving averages. Even if we do bounce up a little bit, it's going to take a lot to get through all these moving averages. All this consolidation here where you had a breakout, that's not going to be any easy matter for the XLE to get through on the upside. That also coincides with right around that $70 level. So even if we were to rally up about 10% from here, or a little less than that, we would still find a lot of overhead resistance at that level. So the XLE struggling, okay, and there's a method to the madness. I'm going to get to that in a second, but let's move on and go to the XLK. Now the XLK, we're on the weekly chart, so the weekly chart is bullish. Not a lot wrong with the weekly chart. We just had a pretty bad week last week in the tech sector, as we remember, from Amazon and Google and Apple and Facebook and Nvidia, across the board, all your FANG stocks and beyond. So we had a terrible week last week, but on the weekly chart, there's really not a lot wrong. This is in an uptrend. There's nothing wrong with having a bad week. We could have an up week next week. We could have another, sideways week, and there still wouldn't be anything wrong. So on the weekly chart, not a lot wrong. On the daily chart, okay, there was some damage done on the daily chart. So this is making a bearish pattern. So the energy sector along with the NASDAQ, so this is a mirror image of the NASDAQ, the NQ, so they're all the same, so I'm not going to go over all of them. So the energy sector making a bearish pattern. However, we're into the 50-period moving average, and we'll find out if the 50 is going to be supportive of the market, and are we going to get through options expiration week and then just take the market back up again, and this will be another blip on the screen. That is possible, so we need more time. Only time will tell on this one. It would be a fool's game to short the market in the hole here, being at the lows or close to the lows. That's a fool's game, this bearish pattern has too much room on the upside to still play out. You could have a lot of whipsaw activity in here. So I wouldn't necessarily short the market in the hole here in the tech sector, but nevertheless, it's not out of the woods yet, so we need more time. Only time will tell. Moving along over to the XRT, which is the retail sector, and the retail sector has been getting beat up lately. When you look at the weekly chart, you can see here below all the moving averages and trending lower. So there's a lot of downward pressure in the retail sector. There's downward pressure for the time being on the short term in the tech sector. The financials are strong, and the energy sector potentially may have found some support, but has been trending lower on the daily chart, is not out of the woods by any stretch. So the reason I wanted to bring this up is because of what's called sector rotation. It's not a mystery, it's not a new term, but large institutions rotate in and out of sectors. Okay, they move money around, they're rotating out of sectors, potentially rotating in others, and also out of the equity market altogether, in part, and into potentially the bond market. And we know what's been going on with the bond market chart of late, so we'll get to that a little bit later. So some of the money's been flowing into the bond market. The chart patterns are one thing, and chart movements are one thing, and we know that chart movements up or chart movements down means higher prices and lower prices. But when you boil it down, when you pull back the onion and you take away the chart, all it really means is money flow in, money flow out. So money's flowing into the bond market from somewhere, okay? Money's flowing out of some of these sectors in the stock market and into somewhere, okay? So that's a fact. That's an absolute. And there's other sectors, but the reason I wanted to bring up this handful is because this is how tops are made. They're not made on the same day. Everything doesn't top out on the same day. But what you'll find when you look back at when some tops are made, and they don't have to be extremely long-term tops. They could be tops for a few months. They could be tops for a longer-term period of time. But as tops are made, when you look back, you'll find that certain sectors started to fall before others, before everything started to fall away. Eventually, if it is a much more meaningful correction, 10, 15, even potentially 20%, then what you're looking at is everything will get thrown out with the bathwater. And so you'll find that certain sectors held up much longer than others, but everything fell in the end. And the reason I wanted to point some of these things out is because if the market was all out bullish across the board and we were going to have another 5-10% run higher in the short run, then you would see a lot of these sectors more bullish than they are now. That's my take anyway. And I have obviously other reasons why I think the market is coming into an important top, at least for a period of time. Doesn't have to be for years. I'm just saying an important top. We'll determine for how long later. But an important top coming up within the next several weeks and potentially out another month and a half or so. But in that time frame, the market should be making a top and beginning a trek down to a corrective phase. That being said, I'm watching everything like a hawk across the board, and when I see sectors that are, acting not in a bullish fashion along with indexes at all-time highs, we want to point it out. We want to make sure everybody's aware of it and use it as not only an indicator of what's likely coming in the market, but also as a learning mechanism for what we can look at on our own across other markets and inside the markets, meaning under the hood, And this is all part of the making of the puzzle. Put another piece of the puzzle or multiple pieces of the puzzle on the table, and we begin to put together what looks to be a picture of what's coming. And as we get more puzzle pieces to put together on the table, the picture just becomes that much more clear. Now, we're on the weekly chart. Let me go back to the daily chart of the IWM. And in the daily, it looks much like the spider today. We were down much earlier, and then we recovered in the spider. We didn't quite get to the moving averages. So this is still a bullish chart. We're still inside this large green up candle here from the 8th of June. As long as we maintain on a closing basis inside that candle, then this is a bullish chart and will maintain above the moving averages. And ironically enough, and nothing is a coincidence, that also happens to be the same level. That's an important number, and why I left it up there for this long, of 138.60. So that repeats over and over again. It's very important to the market. So even if we came back to the 138.60 by some chance to backtest that number, that would be checking back in at home base, if you will, which would be the 20-period moving average, and also the last breakout point where the market broke out the last time. And it would not be out of the ordinary for the market to come back and check out or check back in at a breakout point. Transports. Bullish chart. No two ways about it. Above all the moving averages. Yesterday was a down day. Today was an up day. And the market was down across the board for the most part. So the transports remain bullish. That's a good indicator of higher prices coming. That's my stance. We're not at all-time highs, but we're close to all-time highs. When you look at the longer-term chart of the transports, you see here, this is a long-term bullish chart on the weekly time frame above all the moving averages. So again, bullish chart in the transports. No reason to believe that this market has to crack anytime soon with the transports like this. If you put in some kind of a high volume reversal, even a reversal week, that would change the outlook. But right now, it's bullish, and until otherwise proven, it will stay that way. Moving along, and we'll leave the stock market now. I think we've done enough on that. We'll go over to gold, and we see the downward pressure continue in the gold market. We will be coming into the 200-period moving average here. That comes right around the even number of 1250, give or take. Probably pierce it by a couple of dollars, going down to around the 1248 level, give or take, and should find some support at that level. However, how much support remains to be seen. Just go over to some different time frames, and when you look at the weekly chart here, this could be either building a base, building a bullish pattern to go higher, which it would want to get to this last consolidation point up here. First, it would have to contend with this high here. Well, it's really the same level. So it really would want to get to either this high here from this candle high all the way back from October of 2016, or slightly higher. But if that's going to happen, it would likely need to consolidate for a longer period of time, so you would get more back and forth behavior here. But you can see we're at a critical level right now on the weekly chart in gold into the convergence of the 20-week and the 200-week moving average, and we're below the 50-week moving average. So we have an upsloping 20-week, flattening 200, and a pretty much flat to almost curling over to the downside 50-week moving average. So it's a make it or break it position for the gold market on the weekly chart. So I think it's a very important and critical level. I think this 200 period has to hold for gold to maintain any kind of a bullish stance. On the daily, you could be contending, or you are contending, with a double top that was put in. And so, what's going to happen? Are we going to trade significantly away from the double top, or are we, pardon me, going to make another run for the double top? A lot depends on this week's close, so we'll be watching very, very closely tomorrow's close, Friday's close in the gold market. Silver, if we close below the low from the other day, which is at 16,705, that will be bearish for silver. If we close above that level, it'll be hanging on by a thread. That's all I can say about silver. It's in the same position as gold. It's going to be a critical weekly close for both silver and gold. Silver, you can see here is a different look. We're below all the moving averages, so this is long-term bearish for silver. And what you have also here is a potential of, and I don't believe it's played out yet, but the market symmetry, I could make a case that you have market symmetry from a move here, bearish wedge pattern, that's going to play out all the way down here. Okay, that's from a longer term perspective. There's a lot of support in and around that 1575 level in this general zone. But that, I see that market symmetry playing out down to that level, maybe a pierce of 16. So that's not off the table in my long-term outlook for silver. On the daily chart, I can make a case that this could be an ABC pattern with another leg higher, or we can break down to double bottom down here. There'll be stops along the way. Nothing trades in a straight line, but I can make a case either way. So we need more information, and a lot's going to be dependent on this week's close. Very important close tomorrow in gold and silver. Too early to make a more meaningful call on either one with conviction in gold and silver until I see tomorrow's close. Moving over to crude oil. Crude continues to melt away, so we're heading towards double bottom. So on this current contract, continuous contract, but current month of July is 44.10, and we hit a low today. We finished near the lows. We hit a low of 44.22. So we're pretty close to the lows. At this point, anybody looking for any kind of a long trade in crude oil has to be looking for only one thing. You have to be looking for a signal of a reversal. You have to be looking for a high volume reversal day, a doji, something that contains volume and the signal of a reversal, maybe a pierce of the lows and a reversal from that point, finishing at the highs on volume, something of that nature. And then you can either look for a retracement or hop on board, but you have something to trade against at that point in time. You would be trading against a close below the low of that day. Until and unless that happens, you have to leave it alone and let it fall. Because if we break the lows and close below the lows, then we could trade down farther. So let's go down to a longer term, up I should say, to a longer term chart on the weekly chart. As you can see, there's a lot of downward pressure in crude oil from a long-term perspective. This is just a big rounded top and a big bearish pattern from a different time frame. And I'll get to where the support comes in a minute. But all this is just a big stair step lower and making another bearish pattern for another leg lower eventually coming. Now we can trade sideways like this for another period of time, and this could be years, right? This is a monthly chart. So when you take into an account the amount of time that it took to consolidate before we went lower from here to here, this is 2009 to 2014, sometime into 2015, okay? So that's 6 years, 5 to 6 years. Okay, then we traded lower. So here we are in 2016. So we can trade back and forth in another bearish pattern for several more years. But I just want to point out that this is going to, unless we begin a trek upward, this is going to finish lower. So my point is, back to the daily chart, where is the near-term support? You know, something out to 2020 doesn't help us here. That wasn't my point. Just wanted to give you the long-term perspective. But if we close below 44.10 on the daily chart, then the next major area of support isn't until below 43, 42.87, 42.90, in that neighborhood would be the next major area of support. So any break of 43, we would be looking for another yet sign of a reversal if we don't get one here. So that's my take in crude, and that's not that far away. It's, you know, just over $1 away. We can flush down there overnight, tomorrow, anything can happen. But that's the next major area that I would be looking for the market to support crude oil. All right, moving over to the bond market. And here is the chart of the bonds. And so we had the big up day yesterday. And look at this stair step higher. We flagged this low, by the way. I don't have the line on the chart anymore. But for anybody that's new here, we flagged this low here almost to the tick. And we've had nothing but up moves since then. And we had a pretty narrow ranging day as compared to yesterday. Big up move yesterday. Took a breather today. Stands to reason. Again, I talked about it or touched on it before, so I just want to reiterate here that money is flowing into the bond market and it's coming from somewhere. So while it may not be coming from everywhere in the stock market, right? Financials look okay for now, and there's other sectors that look okay, and the major market, the major index, a spider, looks fine. The money is still flowing into the bond market from somewhere. So it's still coming out of some of the sectors. Just because it's coming out of technology, for example, last week, doesn't mean it all flowed into other sectors in the stock market. Some of it may have, and some of it did. But some of it flowed into the bond market, likely. So the point is that there's nothing wrong with the bond market. It's still in an upswing, and there could be higher prices, should be higher prices coming in the bond market. We're above all the moving averages until proven otherwise. The trend is higher, and the trend is your friend until the end, and we have no reason yet to believe the bond market trend of higher is over yet, although we did see what could be classified as an exhaustion day yesterday on volume of over 450,000 contracts in the bond market. As you can see, as compared against other days, it was a heavy volume day, but still the trend is up, and until proven otherwise, the trend is up. And when you go over to the dollar, we saw the follow through we were looking for in the dollar yesterday, marked what I believe to be the bottom. We pierced the lows, came into, yet again, the bottom portion of that trend channel. That trend channel was interesting, right? And we put in a tail low. We put in a ugly early session, and then we finished near the highs, and we've had follow through today. I think that marks a bottom, and we closed back above the important 96, 97 number. And so therefore, I'm going to say this marks a bottom, but we need to see more. We need to see follow through to the upside. Okay, we're not out of the woods yet, but it's likely a bottom. Okay, but it's nothing set in stone. There's no guarantees anywhere across the markets. But if I have to read it, and I am reading it, and I do read it, I read it as a bottom, but we still need more. We need more follow through. If we get it, we're going to need a close above. This is an important pivot high, 97,475. An important pivot high. This pivot high is 97,515. What was this one? High 475. It's this one, 5,515. Thought this was higher. Nope. Okay. So 515. That's the important pivot. That's going to send, if we close above that level, that's going to send the dollar up to the 50-period moving average. And that's what we're looking for if you're long the dollar with me. That being said, it's everything I wanted to discuss tonight. I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.